So the big question is this: how are investors like us, who don't have a PhD in finance or millions to start investing, how do we grow our bank accounts to build real savings and retirements and yet still have the time to do what we really love? That is the question, and this podcast will give you the answer. Because I think when you look at it like with installment payments, right, no matter what level of wealth you're currently at, when you think about that sort of mentality of, I'm going to take on this, whatever you want to buy, right, I'm going to get it now, and I'm going to have installment payments later, right? You're essentially reversing traditional psychology of investing, where originally you would be like, hey, you know what? I'm going to save, I'm going to consistently invest, we're going to go, and then that consistent investing, that consistent savings is going to compound over time so that the actual amount that you pay for something is significantly less than the initial investments you had to put down to actually get there, because you're able to grow your wealth over time, right? So as your money grows, as your money compounds, it actually fundamentally shifts the amount of the amount of value that you pay for something, because you've taken what you had and you've added an entire new level of value to the capital that you start with. Because if you think about it originally, right, if you put in 50 grand over a period of 5 years, and then you wait 10 years and it doubles, you wait another 20 years, something like that, you get it to the point where in a long-term investment account, it's suddenly, $500,000. Well, now you go out and buy a $500,000 house straight cash. It's so much different than going and putting 10% down. And then instead of having that, solid 10, whatever percent return you're going to get in a long-term index, or possibly managing your own fund and going for like a 20% return every year, which would just be amazing, right? You have that versus a traditional mortgage or a 30-year fixed rate, which is totally cool. And a house is a really, really big example. But think about how you could apply this to maybe a car or a small bike or any other kind of purchase you want to make, where you have the option to save and invest and grow that capital over time, instead of and then you have the payoff, right? The payoff is you get it at the end and it's yours. It's totally you. Versus buying something on credit and then having to keep paying it over and over and over. Because here's the difference, right? When you pay on credit, not only do you have to pay back the capital over time, but you're actually paying interest to get access to that capital, right? So with traditional investing, you're getting rewarded for the assets that you buy. You're getting rewarded for the stuff you put in the market. So you're getting paid to save up for whatever you want to buy. And you're making it easier to buy what you want to buy because you're putting less capital in, since the capital you have is actually gaining in value over time. No matter what you're looking at buying, it's still going to be a significantly less amount of money, because you have put in the time, the effort, and the energy to create that compounding portfolio that's going to then pay for whatever that you want to access in life, versus getting it up front and then being stuck with it. Because when you make those payments, right, those payments, you're actually paying interest, and at the same time, you're not allowing your money to grow. So if you're traditionally getting a 7% conservative post-inflation return, which should really be 9%, because the interest rates and the payments that you make aren't going to usually be adjusted for inflation unless it's for like a credit card or something, the change is going to be paramount to having installment payments, because now you're paying every single month money that's no longer going into your investments, no longer going into your portfolios. It's now going to this entity that gave you this loan, and you're paying for access to money, but at the same time, you're missing out on the opportunity cost of what that money could do in the marketplace, right? Like, you're losing out on that 7%, that 9%. You're losing out on the returns in addition to the interest you pay. So you get like a 4% loan, very, very conservative 4% loan. Usually it's like 10%, but and if you think about that, right? Like, you get 10% loan, that's insane. That's a 17%, if you factor in opportunity costs with inflation in the market, with long-term investments. Think about what that's costing you just to own that thing, right? And it's do you really need it? Because that single entity could be the one thing that's causing you, that financial hardship, that distress. That change in your life it's holding you back, because at a fundamental level, you're not able to move past it. You have to constantly pay down the debt, instead of being proactive, right? It's like reactive versus proactive. At a reactive level, you're taking on initial payments, big debts, and then you pay the debts off over time. You're reacting to them. And that's a very, very bad financial position to be in, because like I said earlier, your debt is compounding to negatively grow the debt that you own, versus positively growing your net worth. Versus being proactive, right? Being proactive is saving, investing, putting the cash away, and doing the work, so that what happens on a longer term scale is that grow and grow and grow and grow. And then once you've been proactive, once you've done it, once you've put in the work, then you take out the cash, then you can withdraw from your funds, then you can do whatever the heck you want and use that as a way to more efficiently get whatever the heck you want in the marketplace. So it's just a totally, psychology is a really big thing. That's what I try to get across in this podcast. It's a lot different than what I do with my written books and all that really awesome YouTube content and stuff like that. Because this stuff it's fundamental. It's the paramount secrets to get you to where you want to be in investing, get you where you want to be in personal finance. Because you're totally separating your current situation from your future, and then you're envisioning your future. Because once you can envision it, you make it happen, and once you make it happen, that's when you're golden. That's when you can do whatever you want. You've established that freedom. You've done exactly what you want in the marketplace, so that you can be exactly who you want in the marketplace and do whatever it is that you want to get any results, because you put in the work, you put in the payment, you've done the investments that have created this long-term fund. And the first step to doing that is finding the cash to invest. It doesn't matter where you are. It doesn't matter what you're doing. It doesn't matter what you're living with. You just have to take what you earn and just freaking figure out a way to not spend it. And then when you don't spend it, you invest, because it's so different. It's like buying a stock versus buying, a new shirt or new pants or whatever. You just have to have the discipline at a fundamental level, especially at the beginning, especially when you're young, especially when you have the time to invest. Separate yourself from the needs and the wants, or just the stuff that doesn't matter, and put it in things that do matter.
Want more stock market secrets? If so, go get your free copy of my best-selling book, 9 to Noon. You can get your free copy plus $11,176 of unannounced bonuses completely for free at 9tonoonsecrets.com. Inside 9 to Noon, you'll find the top 38 secrets we use to double our portfolios every 2 years and make upwards of 10% per trade daily.